Welcome to All About Stocks. You're watching ET Now. Like we did last week, we bring you a brand new segment this week where we design an entire portfolio for you. Every guest on this show will assemble and manage a portfolio, including everything from risk management to allocation of your money. Once a month, we'll revisit each of these portfolios and assess its performance and make the necessary changes. Now, what this means for you is that the homework has already been done. These are ready-made portfolios that you can pick up and use and come back every week to track. Also, for the first time on television, we will make every guest accountable for their stock recommendations. And through this segment, we'll safeguard your money. Remember, there's an email ID at the bottom of your screen where you can write to us and send in any question you might have about the portfolio you're about to see on this show. You can also find a copy of this show on our Facebook page. Joining us now this week is Paras Adenwala, the Managing Director and Principal Portfolio Manager of Capital Portfolio Advisors. Paras, thank you so much for joining us on All About Stocks. It's always a pleasure to have you on this show. And thank you so much for bringing us the portfolio. Before I go into the stocks on this portfolio, tell us what sort of an investor this portfolio is designed for.
It is primarily for an investor who is a long-term investor and can digest a medium risk for a return which is also kind of in the median kind of return. So for someone who is very conservative, probably this may not be the right kind of portfolio.
All right, medium risk, long term, this is the portfolio that Paras has designed for you. I'm going to call out the stocks in this portfolio so you can take them down. Axis Bank, the State Bank of India, L&T, Maruti, Sun Pharma, ING Vaishya Bank, Bajaj Corp, Talwalkars Fitness, PVR and Sobha Developers. Okay, so if you look at that portfolio, we'll see that 40%, nearly 40% is in the banking sector. We have Axis, SBI and ING Vaishya. Tell us first of all why you have such a high exposure to banking, and then tell us why you've picked these three banks in particular.
Yeah, banks, if you look at the composition of our index, which kind of indicates the sentiment in the markets, almost a fourth of the index, is contributed by the market cap of financials. And even if you look at the importance of financials in the overall economy, that again is very, very significant. And therefore, I think it is very important to have exposure or adequate exposure or slightly more than adequate exposure in the financials to be able to outperform the market in a reasonable fashion. State Bank of India, you have an exposure to the country. It is the largest bank in the country. It has exposure to most of the sectors. It has profitability which is among the best. It has CASA ratio, which is the current accounts and savings account ratio, which is also among the best. And in the event of a turnaround of the economy, I think the impact on SBI in terms of bottom line improvement would also be among the best. And the valuations are in your favor, and therefore one has to have SBI into the portfolio. The second is Axis Bank. Axis Bank is the third largest private sector bank in the country and has been growing at a very rapid clip. Its portfolio of loans is a little different as compared to ICICI Bank and HDFC Bank in terms of its exposure to the industrial segment. With the valuations at just about 1.7 times on price to book as compared to ICICI Bank and HDFC Bank, I think the stock looks reasonably cheap. And for a growth which should be nothing less than 25%, I think valuations are pretty cheap and one can really buy into them with a longer term perspective.
What about ING Vaishya in its category among the mid-cap banks? What makes this one the best pick?
The bank has been notching up very, very consistent growth with an improving growth profile. The bank can easily keep on growing at about 25% in bottom line and about 20% in top line year after year, and is also kind of spreading its wings across the country from being largely a south-based bank. The valuations again here are very, very cheap at just about 1.2, 1.3 times price to book on FY14 estimates. So I think there is considerable scope for improvement in the rating for this bank over the next 5 years.
Remember, this is a medium risk long-term portfolio. It's flashing on your screen right now. You'll also notice that Maruti is part of that portfolio with a 10% exposure on it. Paras, can you tell us why Maruti is in this portfolio instead of, say, Mahindra & Mahindra? Because a lot of the guests on this show normally tell us that Mahindra is a better pick.
Yeah, sure. But my belief is that whatever is a consensus investment idea normally does not give the best kind of returns. At best, it will give average returns. And if you look at the last 1 year, Mahindra & Mahindra has clearly been an outperformer within the automobile basket and has also outperformed the Nifty. Maruti, due to problems that are well known, was kind of impacted fundamentally in its operations, and therefore in terms of its performance on the stock markets was also impacted. But my sense is most of the problems now are behind the company, and the growth trajectory from now on will be pretty robust, unless and let's hope that we do not see any more labor problems in the company. If the currency does not play spoil sport, and if there is no labor trouble into the company, my sense is whatever market share that Maruti has lost will be at least regained, if not improved upon, over the next couple of years.
Now, Paras, people who normally write into this show tell us they have 20 or 30 stocks, sometimes 40 stocks in their portfolio. You've picked only 10. Now, tell us why we have only 10 stocks in this portfolio. Can we achieve that diversification with just 10 stocks, and we don't need 30 or 40 stocks?
For a retail investor, it makes a lot of sense to have minimal number of stocks. I'm not talking about extreme concentration, but at the same time, too much of diversification also does not yield the kind of returns that the investors might really want to really have. So an optimum number will ensure that the investors themselves can really monitor the portfolios, and the returns would be really in sync with the kind of conviction that each of the investors would have into each of the stocks in the portfolio. So I think a number of 10 for a portfolio of about 25 lakhs seems to be an optimum number, largely for retail investors.
I also want to talk about your mid-cap stocks here. You have PVR Cinemas and Sobha Developers. Now, PVR rallied quite a bit after that acquisition that it made 2 weeks ago. Would you say the valuations are fair right now for us to buy at this point?
I think, this is a business which is in a transformation phase. From being just into the exhibition business or being only a multiplex operator, the company is gradually transforming into an entertainment company. You will see the business mix getting much more richer, and you will also see the margin trajectory kind of improving over a period of time. The cash flows will also improve. So I think if you put a mix of all together, it becomes a very, very rich business and deserves a valuation which is significantly higher than what it is getting currently.
And with Sobha Developers, now we know there are a lot of retail investors who burnt their fingers on real estate stocks. The nature of the business makes it fairly risky. Do you think it's time really for us to re-enter that sector?
You're right. Real estate, has been a bane for most of the investors over the last few years. But I think most companies in the real estate space are coming out of the shell and have addressed most of the problems that they faced over the last 3 to 4 years. And someone like Sobha has addressed the problems quite early, and to that extent, the stock is already quoting near the 52-week highs. But are the valuations really expensive? On our conservative estimates, they may look a little stressed, but if one looks at the growth trajectory for the real estate space over the next 3 years, in a declining interest rate regime, I think the numbers could be much better than our estimates.
This is Paras Adenwala's portfolio on All About Stocks. Remember, it's for someone with a moderate risk appetite, 5 years time horizon, and these are the stocks he's included: Axis Bank, SBI, L&T, Maruti, Sun Pharma, ING Vysya Bank, Bajaj Corp, Talwalkars Fitness, PVR and Sobha Developers. Remember, Paras did tell us that even though this portfolio has only 10 stocks, it is the ideal number of stocks for us to have as retail investors. It also brings down the management and the amount of time we have to spend tracking these stocks as we manage this portfolio. Now remember, on this show, we are going to track this portfolio on a regular basis, which means Paras is going to be back on the show every month. We look at this portfolio, see how much it's grown, and then make necessary changes. So you want to keep watching the show if you're going to use this portfolio. It's time for a quick question. We have one from Vinod who's written in: 2,000 shares of 8cc bought at 21 rupees. What returns can he expect from this stock over the next 5 to 6 years? Paras?
I think HCC is a very large and renowned company within the infrastructure space, but has been facing a lot of trouble in terms of problems in the infrastructure sector due to high interest rates and due to some policy issues, and has also been facing problems on the Lavasa front, which is the kind of city that it's trying to build near Mumbai. And therefore, I think it may be a while before the fundamentals for the company change. If anyone has to have exposure to the infrastructure space, my recommendation would be to exit out of HCC and get into something like a Jayaprakash Associates or Lavasa and Tubro.
Alright, get out of HCC right now. We have one more question that we can pull out of our Facebook page. Kavneet has written in, he has 100 shares of UltraTech Cement which he bought at 900 rupees. He wants to know if he should book profits right now or hold on for a higher target. That stock is at 1961. He'll make a profit of a little over 1 lakh rupees. Can he hope for more from this stock, Paras?
Absolutely. I think cement as a space has done very well at a time when most infrastructure businesses were down. And therefore, if there is a fillip given to the infrastructure sector by the government, the cement sector can only get better. And therefore, there is absolutely no reason to exit out of the stock. I think recommendation is to hold on.